Okay, to take an in-depth look at the inflation data and its consequences for the pound, with me is Derek Halpenny, European Head of Global FX Research at the Bank of Tokyo-Mitsubishi. Welcome this morning. Thank you very much for coming to talk to us about all of this. I mean, inflation, it is very sticky, and yet we're being told by some that really, please don't worry about it too much because it is going to go down soon. I'm not quite saying when. What's your thought on it?
Sure, I think that's clearly been the message from the Bank of England, and I'm expecting that message to be repeated again when we get the November inflation report next month. So in other words, what they'll do is they'll maybe revise slightly higher the short term or the first part of the profile, but then they'll have it falling again back below 2%. The problem with that is that at some point the markets are going to start losing faith in the Bank of England, and I think that's the risk. I think the worst case scenario for sterling, for example, would be the sense in the markets that as the economic data worsens, the Bank of England is actually in a position where it's not able to respond to that with further policy measures because of the inflation situation and it deteriorating. I
mean, the point is it's going to be very hard to think what they can actually do while inflation is at 3.1% in terms of QE, in terms of interest rates. What do you do with interest rates? Well,
I think right now it's difficult to envisage that they'll sanction quantitative easing. I think the one positive aspect and one way in which the Fed policy transmits itself through the rest of the world is, of course, through currencies. Other currencies begin to appreciate, and that forces central banks to replicate what the Fed has done in the US. But of course, when you look at cable, sterling has really underperformed over the period in which the dollar has been weakening in regard to speculation on Fed policy. So in that sense, I think they have a little bit of time to wait. And certainly if sterling started to appreciate significantly and the data started to worsen, then I think they're in a better position to implement some form of quantitative easing, possibly early next year.
Looking at the idea that sterling might appreciate, with the current round of spending cuts that we're about to see, these huge spending cuts in the review on the 20th of October, is it likely that we're going to see any appreciation sterling?
It's not our view, actually. We think the dollar has been oversold in this move in regard to QE2 from the Fed. One estimate, for example, from a professor in the United States is that about 1.2 trillion worth of asset purchases is now priced into the market.
Right, so it's already there.
It's already there, and now we're seeing the markets begin to shift the potential of maybe $500 billion being announced over a 6-month period, and I think that certainly is priced. So therefore, I think the big difference between this and, say, quantitative easing 1 is that it's been front-loaded, it's fully priced now, whereas it wasn't in March 2009.
Okay, thank you very much indeed for all of that. Come back and talk to us again soon.